Imagine this. You wake up one day and all of a sudden your mortgage payment has exploded. Your 401k, it's been cut in half. Gas is at $12 a gallon, and your grocery bill feels more like it's a car payment. This isn't some distant apocalypse. This is what happens when the world decides that America is no longer worth lending to. So let's talk about what happens if everyone stops buying US debt. So the US is facing a potential debt bomb. I mean, it's been the topic of conversation throughout the news over the last several years. It was one of the main topics when it came to the election. That was how much debt the US is carrying and how significant the interest costs of that debt are becoming. And all of that combined, along with the craziness that's going on in the global economy right now with respect to trade wars, is leading many countries and many investors to lose confidence in the US debt. Investors are starting to fear defaults on what was once considered the single safest investment that somebody could make. And there's real fear that the debt growth is at some point going to outpace the economic output of the United States, making it essentially impossible to be repaid and making it highly likely that the interest cost is going to dig into many of the things that Americans value so highly. Things like defense spending, social programs, and a whole bunch of other political stuff that is very, very, very important to both sides of the political spectrum. And the reason why this is so important is because the US relies on this debt to fund government spending. Military expenses, social programs, things that make America America are largely funded by the government, spending money that it doesn't have at this moment, but using the credit that it has worldwide in order to fund these programs at very low interest rates, but interest rates that are appealing to other countries and investors because of their relative safety to everything else. And that's why foreign investors hold trillions and trillions of dollars worth of US debt. It's because of the confidence, the universal agreement that that debt is the safest asset that somebody, a country, or an investor, a corporation, whatever, can park their money in. And when that confidence starts to wane, that becomes problematic. But what's interesting is the notion that foreign countries hold the majority of the US debt. And this actually isn't the case. In fact, foreign nations own less than a third of the US national debt. Most of the national debt is actually debt that is owned by American citizens. It is money that is owed to the very people that the borrowing has benefited. In fact, the majority of US debt, almost 50% of it, is held by individual US citizens and investors. Another 12% is held by the Federal Reserve, and about another 15% after that, give or take a little bit, is set aside for things like Social Security, US military retirement funds, and US civil service retirement funds. In fact, the largest foreign holder of US debt, which is Japan, only holds about 3.2% of the national debt. So when we ask the question, what happens if everyone stops buying the US debt? What we're really asking is, what happens if foreign countries stop buying US debt? And the answer to that question largely depends on the psychological circumstances that a reluctance of foreign countries to buy US debt would create. And not only that, it's more a question of what would happen globally if everyone stopped buying the US debt. Because globally, there is significant dependence on the US being the world's most stable economy. Most of the reason that foreign nations actually hold the US debt is to support their own individual currencies. The fact that a country like China or Japan has US debt in its reserves actually supports their own unique currencies, giving other nations and foreign investors the added security that it's not just that nation's word that they're taking for it with respect to their individual currencies, but it's also a little bit backed by the US. And in that way, that largely ties foreign countries to the US financial system. As we saw in 2008, when the US catches a cold, the rest of the world got the flu. And when there's a lack of confidence in the US economy, that also creates a global recession risk. So it's in every country's best interest that the US debt remains stable, the US economy remains stable, and the US currency remains stable. And this is especially true for China, which I'll get to a little bit later on. But the historical stability of US debt demand can't be ignored, and it should be valued as well. US treasuries, US bonds are viewed as the world's safest assets. And their demand has persisted through recessions and crises. And interestingly enough, as I'm filming this video, many people believe that many countries are abandoning US debt. There is the basic assumption that because there is a trade war or a potential trade war happening, that everyone's put a full-on stop on buying US treasuries. But that's actually not the case. In fact, in the most recent month prior to filming this video, foreign purchases of US treasuries actually increased, almost doubled over the previous month. And quite often that's the case. As things get bad in the stock market and in foreign economies, US-backed debt seems to be the place that people still go, even when things seem troubling. But it also can't be ignored that it's getting a little bit weird because global geopolitics are shifting. We're starting to see a bifurcation of the global economy. We went from having a global economy that was becoming more holistic and more one to one that is now bifurcating, with it basically being the East versus the West. And that could shift demand for US debt, and it could make things for the US dollar interesting to say the least. But I'll talk about that in a minute. But first, let's talk about why we're here and why the US debt has gotten so big and why the confidence in it has basically come down. And that's largely due to the fact that stimulus has a cost. In 2008 and during COVID, we saw the US inject a significant amount of support or stimulus into the economy. And not just for the benefit of the United States, but for the benefit of the global economy. Now, there were some lessons here from the Great Depression that made it clear that the government doing nothing was not a great option. Now, it can be argued that the government doing too much may not be a great option either. But this stimulus was largely funded by debt. And that debt is what allowed many people to not suffer as much as the people who suffered during the Great Depression. This stimulus wasn't the result of the government just going, we need to do something. It was a very calculated response to several very serious situations. But the problem is the short-term relief caused a long-term debt burden, one that our children are probably going to be dealing with for decades and decades to come, maybe even centuries. But the bigger problem is that deficit spending became baked into policy. So the additional spending didn't stop once things got normal. A lot of it continued on. And this is probably a lot of the reason why Doge and the whole cutting government spending thing became such a hot topic over the last year. And whether you want to hear this or not, I'm going to tell you right now that the best time for governments to cut spending is when things are actually good, when the economy is working well, when the stock market is performing well, and when people can actually afford to have a little bit of adversity that isn't the same sort of massive adversity that comes with things like a financial crisis and a pandemic. This is the type of thing that needs to happen in order to make sure that there isn't another big financial crisis, one that's potentially worse than the one that happened in 2008. But nonetheless, that added spending, the higher and higher deficits, and the greater and greater debt is leading us to a situation that could be problematic. And it leads us to have to face this question. What happens if demand for US debt actually does evaporate? Well, let's talk about that. First of all, let's talk about the economic impact on the US. Reduced demand absolutely will equal higher interest rates. If the debt that the US Treasury is issuing isn't being bought, the way that you attract investors or foreign nations to buy more of it is by making it more attractive by increasing interest rates. And there's a point where you increase the interest rates on it enough that it becomes a no-brainer. The risk becomes worth the reward. Now, if all of a sudden there's a lack of confidence in the US debt, that means it's no longer the safest investment on the planet, which means it's more risky, which means you have to increase the returns that an investor is going to get if they do decide to invest in it. That's just the way markets work. Now, the problem with this is if you increase these interest rates, the borrowing costs on pretty much everything else surge. Mortgages, prices for that surge. Credit cards, prices go up. And when I say prices, I mean the interest rates. The interest rates, if the US Treasury rates go up, the interest rates for all other kinds of debt also increase. But not only that, the federal deficit and the debt servicing costs of that deficit, the US national debt, they increase as well, with billions and billions more dollars having to go towards paying the government's debt. And I'll get to how that affects you and how it affects the US economy in a second. But with these rising rates comes rising risk, because debt repayments, well, they rise sharply. It gets more expensive to have a car loan, have a credit card. The costs of debt for everyone, the individual, the businesses, the government, they all go up. And this crowds out the ability to spend on other things. If all of a sudden you've got this massive amount of money that has to be spent on servicing the US's national debt, the money has to come from somewhere. So all of a sudden we can't spend as much on the military or social spending. And as a result of that, the military falls behind. It gets weaker as other superpowers build up their military. And that's something that the US definitely does not want to happen. And the US budget, increasingly becomes consumed by interest costs. It's no longer going to help individuals or help businesses or support the country and its infrastructure. It's now going towards paying interest to other nations or the people that own the debt, which becomes problematic because that money essentially evaporates into thin air and becomes a benefit for somebody other than the US government and ultimately other than the US citizens. And in addition to that, if there's fewer buyers and there's weaker demand, that also means it has an impact on the value of the US dollar. And if the value of the US dollar goes down, that also means that inflation starts to rise, primarily because imports become more expensive. If what you used to be able to buy from other countries for $1 now costs $1.25, that is the definition of inflation. That is a price increase simply because the value of one currency is less than the value of another currency. And by the way, this is also problematic for the other countries. I'll explain how it's problematic for China a little bit later on as well. But there's a very clear case study for all of this. There's the lesson of Venezuela, once the richest nation in Latin America. And it was very simply that Venezuela relied too heavily on foreign credit. Now, they did a whole bunch of stuff with their politics that made it unbearable for any investor, especially a foreign one, to even think about investing in Venezuela. But as a result of that, the appetite for Venezuelan debt pretty much ceased overnight. And this collapse triggered a bondholder flight. Everyone basically said, nope, we want our money out. We don't care what the returns are in Venezuela. It's not worth the risk of investing there. And this basically made the Venezuelan currency worthless overnight. And this caused an economic catastrophe, taking Venezuela from being one of the wealthiest nations in Latin America to being one of the poorest pretty much overnight. Now, let's contrast that to what could happen if the US defaulted on its debt. Because many central banks, well, they hold US dollars, and they hold US dollars because holding those dollars actually props up the value of their own currencies. But if all of a sudden those US dollars were worth less and the treasuries that they held were worth less, this sort of default, this sort of issue with the US debt could shake global markets. And with that level of uncertainty associated with what was once the most reliable currency and the most reliable investment that anybody could make, well, that could collapse currency values and trade could crash because, unlike my previous screwed up analogy about the US catching a cold, the reality here is that when the US sneezes, the world would definitely get a cold. Then there would be the interest rate shock. So the loss of buyers of US bonds would create falling bond prices and rising yields. So in other words, the interest rates go up. And a 1% increase in rates would add trillions of dollars worth of costs for the US government when it came to servicing the debt. So in other words, the monthly or the annual costs would go up significantly. And this would flow through to the private sector, making pretty much all forms of borrowing more expensive as previously discussed. But that would lead us potentially to a debt spiral. You have higher interest rates, that creates higher debt costs, which creates higher deficits. And this feedback loop could make it so that the US found itself in a situation where not only was the national debt growing, but it was growing at a rate where you couldn't stop it from growing. And this feedback loop would have significant impacts on fiscal policy. Fiscal policy being the federal government's spending policies. With less and less money available, taxes would have to go up. And if taxes can't go up enough to feed the spending, well, there has to be cuts somewhere. And quite often it is the most marginalized people who feel the greatest pain from cuts that happen as a result of this type of policy. But then you might say, well, but what about the Fed? Couldn't they just step in and buy all the bonds that aren't being bought by foreign countries and everyone else? Well, the answer is yes, but it would cause a bit of an issue. Because this sort of quantitative easing, which we've seen before, puts the Fed in a very difficult position, one that compromises the integrity of the Fed itself. And the dilemma would quickly become, do we fight inflation or stabilize the markets? Because in order to fight the inflation, we would have to increase interest rates. And keep in mind, again, that the inflation comes from the US dollar collapsing and the costs of goods that are being bought from other countries going up significantly. So, on the one hand, you have to increase interest rates to combat that and to make it more attractive for foreign buyers to come in and buy things. But on the other hand, if you increase interest rates, you're going to put a significant downward pressure on the markets and on businesses and consumers in general as well. So yeah, we might be able to bring down inflation, but we're also going to stomp out growth. So this quickly becomes a no-win situation, especially when you consider that the Fed has a dual mandate to both fight inflation and keep employment stable. But in these sorts of scenarios, if you are fighting inflation by increasing interest rates, you're also doing significant damage to jobs. So essentially, the job of the Fed would become impossible. They would have to pick the winners and pick the losers. Not to mention the fact that if they do decide to buy the debt because nobody else is buying it, well, the way in which they do that is by printing more money. And if they're printing more money, that becomes inflationary, which means you have to increase interest rates again, which means you're potentially destabilizing the markets and businesses. It's a no-win situation, and everybody will get hurt. So this would leave the US government with two really bad options. The first would be austerity measures, which would cause significant political backlash as programs were cut and the US basically said, we need to do everything we can to spend as little money as possible. We'd also need to raise taxes, and everyone's going to feel a lot of pain for a pretty significant amount of time. The other option is print more money and fuel the inflation, and we all know that this is not a good option either. So essentially, between the Fed and the federal government, there is no easy way out. Whatever decision that you make because of the loss of confidence in the US debt and the US dollar leads to pretty severe consequences. But this isn't just a problem that is homegrown, because there's a global impact as well. If the bond yields are rising in the US, other countries have to increase their bond yields as well to become more competitive. And this could cause a flight to other safe haven assets, things like gold and maybe the euro or the yen, maybe even things like stablecoins or Bitcoin. But essentially, the risk of pretty much every type of asset goes up. It increases. The volatility increases, and nobody knows where to park their money. And that could create a geopolitical fallout. Maybe China or others pulling out signals a loss of trust in the US debt. And the very action of China or other countries pulling out in order to protect themselves becomes seen as economic warfare, especially in scenarios where there's conflict, like during times where there are trade wars. And this ends up pushing the US to more self-reliance, which becomes very difficult, especially considering how interconnected the global economy is. Which brings us to China's role in this whole conversation, and it's a big one. Because the US-China debt dynamics are constantly changing. At one point, China held over $1.3 trillion in debt. Now, 12 years later, they have under $800 billion worth of US debt, and they just sold about $300 billion worth. And the gradual sale of this debt signals risk aversion. They aren't sure that the US is A, going to be a reliable trading partner, and B, is going to be the type of economy that supports the idea that their debt is risk-free. So what they could be doing is gradually dumping US treasuries. But they need to do it gradually because if they were to do it all at once, they actually risk hurting their own economy. Because they hold so much US debt, dumping that US debt and hurting the values of that US debt would actually hurt the Chinese economy in its own right. So for China, abandoning the US debt actually is the nuclear option. It hurts both the US and China itself. By the way, I made a video on this that you can find on the channel. I'll probably put it right up here, where I talk about how China could actually weaponize the holdings that they have of the US debt in order to do significant damage to the US economy. I also talk about why they wouldn't do that because it's absolutely crazy. So while the weaponization of US debt by China is definitely a possibility, it very much is the nuclear option, something that is highly unlikely to happen because it again is likely too damaging to the Chinese economy to actually be used aggressively. But still, there's significant signaling powers that China holds. And if even for a second the world believes that China actually is selling out all of their US debt, that could essentially cause, for lack of a better word, a run on the bank, with the bank being the US government. And this could essentially create a realignment of global reserves, which we're already kind of seeing. We could see a shift towards gold or the euro or other assets. And we could see further trends towards de-dollarization, moving towards currencies that aren't the American dollar. And this would eliminate the US's benefit as a convenience lender. In other words, a lender that can pay a slightly lower interest rate because of the security associated with it. And there's real reasons for countries like China to stop buying US debt. First is the geopolitical risk. We already saw this with Russia, where the US essentially was able to cut them off from the global economy. And with tensions increasing between China and the US, the fear of sanctions like that are becoming more and more real and more of a reason for China to start diversifying its assets. And not only that, it seems like countries all over the world want to continue to reduce their reliance on the dollar. And for China, this definitely means that there's an opportunity for their currency to be more internationally recognized. Now, there's a whole bunch of other stuff that would have to happen in order for that to be a real possibility, including China being more open about allowing foreign investors and not doing things to artificially reprice their currency. But it is definitely a real opportunity for China and the Chinese economy. But here's the other problem, is if they do reduce US debt, there's some risks that are associated with that, because it could increase the value of their currency, which is something that China doesn't really want, given that they're the world's manufacturer. Because the more that their currency goes up in value, the more the goods that they sell cost. And not only that, they lose a safe and liquid investment vehicle, one that they can trade with other countries pretty freely, especially when other countries don't want to trade in the Chinese currency itself. So what would likely happen is China's strategy would be more gradual. They'd sell in small amounts over time to avoid disruption. They may look to other types of US investment instruments instead, and they more than likely will continue to increase their gold reserves. But there's only so much, by the way, that they can do when it comes to increasing those reserves. And it's highly unlikely that they will ever, in my lifetime of years, be able to buy enough gold in order to match that of the United States. Now, all of that being said, the real question is are we really in trouble here? What can we learn from past demand interruptions? Well, the reality is this has happened multiple times. 2015, 2016, China sold treasuries in order to defend its own currency. 2018, 2019, during the first trade war, they reduced holdings in order to essentially penalize the US. And in both of those scenarios, bond yields did increase, but the increases were moderate, not extreme. And the US Fed and the private sector, well, they helped absorb the selling that was being done by China and other countries. So there was no crisis, but it shows the importance of market confidence, because just these small shifts in China's holdings did have an impact on the yields associated with those treasuries. And if the market confidence got significantly worse, but if there were a scenario where the market confidence got shaken even more than it did back then, that could mean significantly higher yields. That could create a pretty significant problem. And what could happen is we could start to see other countries reduce their treasury holdings in response. They could shift their holdings from US treasuries to other types of bonds, and it could create a scenario where capital markets become more fragmented. So in other words, some countries choose to only deal with some countries and other countries deal with other countries. And instead of everyone participating in a global economy, the global economy becomes fragmented. Now, there's also the possibility that if everyone stopped buying US bonds, there would be new equilibrium possibilities. So the US could stabilize everything just by having higher interest rates and reduce the deficit. And this could actually go a long way to benefiting the US and the global economy as a whole. And if they do increase interest rates, investors may return. China, Japan, other countries may go, wow, the US is paying such good interest rates and it's still such a safe option that it makes sense for us to maybe go back to the well and buy some more assets. But we could also see the global financial order evolve into a multipolar system. And the way things are going with the BRICS nations right now, that's becoming more and more likely. But keep in mind that this has been tried before. There's a reason that the European Union exists, and the Eurozone exists, and the Euro exists. It's because at one point, these countries wanted to make sure that they weren't completely reliant on the US dollar. And, well, even though the euro still exists, it didn't have the cachet and the ability to dethrone the US dollar as the world reserve currency that everyone hoped it would. And the BRICS nations, which are a group of arguably less stable nations, well, even if they do come up with their own currency or system of trade, they may find themselves having the same fate. So to wrap this all up, what happens if demand collapses? Well, higher US borrowing costs for sure. There's going to be a weaker dollar. With a weaker dollar, inflation will likely increase. That would create tighter global financial conditions. US sneezes, everyone catches a cold. And China and others also face significant costs as a result of there being a lack of confidence in the US debt. But here's the bottom line. In the same way that the global reserve currency didn't shift from the British pound to the US dollar overnight, it's in every nation's best interest that the US dollar doesn't collapse immediately. If there is going to be a new global reserve currency that emerges, it needs to be done gradually, which means that every nation has a vested interest in making sure that there's confidence that remains in the US financial system. If there is a gradual shift to another currency one day, fine. But sudden shifts would create systemic risk, not just to the US, but to everybody. And this is why it's so important for other countries to continue to support the dollar, and why they continue to do that, especially when things get scary and things get volatile. But it's also why the US has a duty to the global economy to make sure that they get their deficit spending in check, that they stop running up the debt, and that they start to operate once again in the stable and reliable way that they did previously. Because it's highly unlikely that everyone stops buying US debt. But if they did, we've got significantly greater problems than the fact that the US is spending too much. Oh, and by the way, if you want to see a really cool video on what would actually happen if China tried to weaponize US debt, make sure you check out this video right here.